Hey there, financial enthusiasts, and welcome to the Edgar Investment Management YouTube channel, the place where we unravel the mysteries of money and make sense of complex financial decisions. I'm your host, Matt Edgar, and today we're diving deep into a topic that many of us grapple with, the mortgage dilemma. Should you use available cash to invest, or should you use that cash to pay off your mortgage? Now, if you're new here, don't forget to hit that subscribe button and ring the notification bell so that you never miss any of our financial deep dives. All right, so let's dive in deep. Everything that we're going to cover today, from why would somebody invest rather than pay off their mortgage, to some key interesting findings and very interesting data that we discovered. Also, if you've ever wanted to dip your toe into the world of coding, you definitely don't want to miss the loop timeline part of the presentation. We even have a full video that goes into more detail on the behind the scenes of how we were able to create the analysis through coding. So you won't want to miss that. All right, so maybe you got yourself an inheritance or a big bonus, or you won the lottery, whatever it might be. Let's say you just came into some money and you have a choice. And that choice is, should you pay off your mortgage, or should you take that money and invest in the S&P 500? So here we've got two options, right? Option number one is to pay off the mortgage now, which you'll have a paid off house, which is nice. Option number two is to take that same amount of money, invest it into the S&P 500, and then use that cash flow on your earnings from the S&P 500 to pay off your mortgage or to make your mortgage payment. The goal is, in that case, at the end of the mortgage term, you have a paid off house. But we also want to have a positive investment balance. So let's take a look at two scenarios here, and they're really the same scenario. So under scenario number one, you have a large amount of equity in your home. So maybe your house is worth $500,000. You have a mortgage of $100,000, so you have $400,000 of equity in that house. Now, in that situation, you can do a cash out refinance, right? So maybe you take cash out of that equity of maybe $200,000. In scenario number two, we have excess cash, which is sufficient to pay off or pay down our existing mortgage. And maybe that's $200,000. So in both cases, you have access to cash. In one case, you can pull that cash out of your equity. In scenario number two, you actually have that cash. So what are we going to do with that cash? Well, we're going to set up an investment account. So throughout this presentation, we're going to use the number $200,000. That's an example. You might have $100,000. You might have $500,000, $1 million. Doesn't really matter. For our purposes, we're going to use $200,000, but you can scale these numbers accordingly. And then each month, that money would be withdrawn enough to pay the monthly mortgage payment. And the idea is, at the end of our mortgage term, we want to have some money left in that investment account, plus we want to have a paid off house. So we're going to invest that cash in the S&P. Okay, so the whole reason something like this could work is found in the difference between the invested growth that is earned on the S&P versus the mortgage interest rate. So if the investor expects a return of, let's say, 9.5% from the S&P 500 annually, and the mortgage rate is only 3.5%, then you can already see that not only does the return cover that 3.5% mortgage rate, but you get to pocket the remaining excess return. But what if the market is down? Well, that will be a possibility, but we aren't starting off from zero. So remember, we have that $200,000 that we're starting off. So we have the ability to take that risk. Plus, with the excess returns in excess of 3.5% on the mortgage rate, our balance will continue to help when there is a downturn in the market. But it doesn't stop there. So since we're talking about houses, there is the possibility for the house to appreciate over time, especially depending on the location and if there were any upgrades or renovations. So it's a bit of a double whammy in terms of the investment balance growing, but also the property value growing. So let's take a look at a actual scenario that happened from 1993 to 2023. Now, this is just one of the scenarios that we analyzed, but it's a 30-year period from 1993 to 2003. Of course, there are assumptions that we had to make. First being that the mortgage is a 30-year mortgage with a 3.5% interest rate for $200,000. Now, that information is shown in that orange line. So if you take out a mortgage in 1993 for $200,000 at 3.5%, over the course of that 30-year period, that $200,000 mortgage, you're going to end up paying back $323,000, just a little over $323,000. So let's take a look at this other line here, which is this blue line. If you were to invest $200,000 into the S&P 500 in 1993 and let that grow for 30 years until you get to 2023, that $200,000 would end up becoming 3.19, almost $3.2 million. So you can see, that $200,000 grows at a much faster pace than the mortgage debt would grow. So let's take a look at this middle line, which is the green line. And what this line is it's doing exactly what we're talking about in this video. It's taking that $200,000, instead of paying it off, you take on a mortgage of $200,000. You invest the $200,000 in the S&P. You use the earnings from the S&P investment account to pay down the mortgage account every month. Well, what happens at the end of 30 years, from 1993 to 2023, at the end of 30 years, you've paid off your mortgage. The mortgage is gone. The house is yours. It's free and clear. But in your investment account, you now have $1.6 million. Now, this isn't really a hypothetical in the sense that we know the returns on the S&P. We know what the mortgage would have cost. If you would have done this on a monthly basis, your account would have ended up with $1.6 million in it. Plus, you would have ended up with a paid off house. Who knows how much that house is worth after 30 years. All right, so that's the overview of where we're going here. But let's take a look into the details. So keep everything that we talked about in mind up to this point, because we're going to cover some ground before we get into the fun part, which is all the data. So you can't make an analysis without a data set. So what did we do? Well, we gathered monthly data from the S&P 500 from January 1926 to October 2023. We got that information from Dimensional Fund Advisors, which gives us 1,174 months of return data. That's a lot of data. So the software that made all this possible was RStudio. That did the intensive part of the analysis, but we also used Excel to organize and make the findings presentable. So if you're not aware of RStudio, it's a programming language for statistical computing and graphics. Don't worry, we're not going to go over all the coding in this video, but we do have a video on our YouTube channel that goes down into all the details on how this analysis was done, including all the coding, loops. I mean, it's a really great video. But we still need to go over the overall idea. So we wrote some code that created a cash out refinance amortization table that shows us by month the investment beginning balance, the monthly return on our investment, the monthly gain or loss, the principal amount and interest on the mortgage, the investment ending balance for the month, the mortgage beginning balance, and then the surplus or deficit for each month. So it's pretty complicated. Then we wanted to look at as many 360 periods as possible. So we wanted to go back in history, and we wanted to see if you did this idea of taking $200,000 and using it to pay off a mortgage of $200,000 on a 30-year mortgage. Does this work all the time? Does this work every 360 month period? So we had to go back all the way. We went all the way back to 1926. And what we did is we created loops with our data that would actually study this and say, okay, it's paying off the mortgage, it's earning investment returns. And we coded this into R and basically ran the analysis from there. So I know this seems a little confusing. But we have an example and a graphic that's going to help us explain that. So let's take a look at that graphic. So as you can see here, loop one starts at time period one, and it goes through month one, month two, month three, month four, all the way up through month 360, and then it ends. And then we start a new period, loop two. Loop two starts at month two, goes to three, goes to four, and then loop two ends at 361 because we're moving forward a month at a time. So we ran our analysis and we looked at two mortgages. Now, these numbers may seem familiar to you from the previous examples, but we're going to continue to use them for the remainder of our analysis. But we wanted to look at a couple different scenarios. So mortgage number one is a $200,000 mortgage. It has a 30-year term. It has a mortgage rate of 3.5%, has 360 payments. That's 30 years. Our monthly mortgage payment is $898.09. We also wanted to take a little bit more extreme mortgage. Mortgage number two, $200,000, 30-year mortgage, 360 months. But instead of having a mortgage rate of 3.5%, we had a mortgage rate of 7.5. We're obviously going to make 360 payments. Our mortgage payment is $1,398.43. So what we're going to do is we're going to take that mortgage amount and we're going to invest it into the S&P. The funds from that investment account are going to make the mortgage payment. Now, in the event that the investment account balance goes to zero prior to the 360-month period, i.e. we run out of money in our investment account, the mortgage holder would just need to start paying the mortgage with other funds, right? Funds from your employment or side hustle or whatever it might be. And then we're going to assume that the investment account is fully invested in the S&P 500 for 30 years. So there's no diversification between international or anything like that. So what we did with this analysis is we went all the way back to 1926 and we looked at every 30-year period, every 360-month period, beginning from 1926 all the way up through 1993. Now, the reason we went all the way up through 1993 is because obviously a mortgage in 1993 would just now be expiring, but a mortgage after 1993 hasn't expired yet. So we haven't had a 360-month period yet. So what are our key findings? Well, if you did this idea of investing the $200,000 and using that to pay off your mortgage, the very worst month to start was September 1929. If in September 1999 you would have done that, that would have been the worst month to start. You would have ended up paying $234,693 out of pocket at the end of your 360-month period. However, the best time to start was 3 years later in June of 1932. If you would have done this in June in 1932, at the end of that 360-month period, not only would that mortgage be paid off, but you would have had $9.1 million in your investment account. This is just sort of staggering to think about, right? In June of 1932, you take out a mortgage for $200,000. You invest that in the S&P. You use the earnings from that account to pay off that $200,000 mortgage. At the end of that mortgage term, it's paid off, and you have $9.1 million left in your investment account. That's a really pretty amazing thing to think about. So that was the best month to start that. This is all under mortgage one. Out of the 815 loops that we did, only 4.91% of those loops ended with a negative value for the mortgage. If you look at mortgage number two, 23.31% ended with a negative value. So let's take a look at sort of the overall statistics for these mortgages. So you can see here mortgage one, let's just focus on that for a second. That's the one with the 3.5% mortgage rate. So if you just take out the mortgage for $200,000 and you don't do any of this investment stuff we're talking about, you just take out the mortgage and you pay it back over the course of 30 years, the mortgage is going to cost you $323,000. Okay. However, if you did this in the worst month in our data set, which was September 1929, that mortgage would have only cost you $234,000. So you're actually even though you ran out of money in your investment account, you still paid less on that mortgage than if you would have just done nothing and just paid off the mortgage. If we look at the average from 1926 to 1993, on average, the ending investment balance of doing this scenario would have been $2.45 million. And as we said, the max ending balance was $9 million, a little over $9 million, which was June of 1932. The worst month was September of 1929. 4.91% of our scenarios didn't end up with any money at the end of this, at the end of the 360-month period. Now let's take a look at mortgage number 2, which has a higher mortgage rate, 7.5%. So obviously, if our mortgage rate is higher, our payment's going to be higher. The difference between our mortgage rate and our expected investment return is going to be smaller. So we would expect this to just look worse than mortgage 1 because of the mortgage rate. So in that case, if you took out a $200,000 mortgage at 7.5% for 360 months, at the end of that period, you would have paid a total of $503,000. If you did this on the worst month that you could possibly start, which again is still September of 1929, that mortgage would have ended up costing you $426,000. So you'd still be better off by doing this than just paying the mortgage by itself. The average ending investment balance under mortgage 2 scenario is a little over $1.1 million. So on average, you're still better off doing this scenario, even if you have a higher mortgage rate. The max ending balance, investment balance, was a little over $7 million, $7.2 million. Again, the worst month to start was September 1929. The best month to start was June 1932. Now, there is something to, sort of look at here. By increasing that mortgage rate, the percentage of those scenarios that end up with no money in the investment balance actually goes up quite a bit. It goes up from 4.9% to 2.3%. Now, that being said, it's still cheaper, or it's still better an idea to do this because your overall mortgage cost has been reduced by doing this investment. But in 23% of the scenarios under mortgage 2, yes, you have a paid off mortgage, but you don't actually end up with anything in your investment account. So tables are great, but let's take a look at a nice little graph here. All right, so what is this graph telling us? Well, we've got both of our mortgages graphed on here. Mortgage number 1 is our 3.5%. Mortgage number 2 is our 7.5%. Mortgage number 1 is blue. Mortgage number 2 is orange. And what this graph is telling us is these are the spots that, these are the ending balances in our investment account after 30 years, after 360 months, after the mortgage is paid off. This is how much we're going to have in our investment account. And this is real data. This is data that we went back and grabbed from the S&P and built into our amortization table. Definitely, you can check out that video of how we did the detailed analysis. We'll put a link down in the description. But this is the actual balance that you would have had. So you can see here, one of these first data points, 1926. After 30 years, you're going to have about $600,000-$700,000 in your investment account. Now let's just take a look at this blue line. You can see, from 1927 to the early 1930s, if you would have done this scenario where you took out the mortgage, you invested, and then you use that investment account to pay back the mortgage, you actually, wouldn't end up with any money left in your investment account. But the really interesting thing to see about this blue line, the 3.5% mortgage, is that after the early 30s, you're going to end up with money in your investment account every single monthly period all the way up to 1993. There hasn't been a period where this blue line goes below zero. Every single month of every single year, the 360-month period, at the end of the 360-month period, you end up with money in your investment account. Now, obviously, we're talking about past. That doesn't mean that it's going to happen in the future, but all we have is the past. So we're only doing, we're doing an analysis on historical data. So that's a really interesting thing to notice here. Now, it's not quite the same with mortgage number two, which is our 7.5% mortgage. You can see obviously the 20s and into the early 30s was still a bad period if you have that 7.5% mortgage and you're investing in the S&P. But then, of course, we get that spike in 1932. But what you will notice is there have been a couple periods since 1926, going through 1993, where this orange line dips below that zero line, right? So you can see in the mid 30s, again, little blip in the 50s, in the 60s, there was a couple periods of time here in the 60s. Of course, in the 70s, we had a little bit of issue. And then since the 70s, even with a 7.5% mortgage rate, we've been above on our investment balance the entire time. So obviously, if you have a higher mortgage rate, it does make it a little bit more challenging to make this situation work. But it's all going to mitigate the overall cost of your mortgage. I mean, even these little negative numbers down here are going to be less negative than the mortgage itself. So this data is organized in terms of time. So we start at 1926, we go all the way up to 1993. But let's take a look at this data if we organize it in histogram. So what you're going to find here is we've divided up all the ending investment balances minus the mortgage, of course, into bins of $500,000. So bin number one is negative 500,000 to a zero. Bin number two is the next 500,000, so it's from 0 to 500,000. And it ends with bin 20, which is 9 million to 9.5 million. But what stands out? Well, the biggest number of scenarios is in bin 1, and it is for mortgage number 2. This means that for mortgage number 2, 190 scenarios ended their 360-month period below zero, while only 40 ended in that bin for mortgage number 1. Now, keep in mind that when we say they ended up under zero, they still paid off the mortgage, right? So it was still less than if you had just paid the mortgage, right? I mean, you still ended up in a better off position, but you didn't end up with any money in your investment account in those scenarios. However, what really stood out is bins number 4 through 7. Now, these have more than half of the scenarios for mortgage number 1, with a total of 513 that landed between $500,000 and $2.5 million. For mortgage number 2, the same can be said for bins 2 through 5, where 446 scenarios landed between $0 and $2 million. But we can still see a nice spread further on out with seeing higher numbers in scenarios from 3 million to 4 million. So yes, the 190 scenarios where we ended below zero, isn't great. I mean, we want to end up with something left in our investment account at the end of the day. But it's also important to notice that a lot of those scenarios happened at sort of historical financial moments, like financial crises on Wall Street and things like that. So in summary, the data from this extensive analysis really paints a promising picture for those considering a unique sort of approach in their mortgage management, right? The idea of taking the money and investing it in the S&P instead of paying off your house, and then using that investment to pay off your mortgage. So the historical S&P 500 monthly data from January 1926 to October 2023, really showcases that the majority of scenarios end up with a positive investment balance. So when we consider that 3.5% mortgage rate, we have a whopping 95% of all scenarios conclude with a positive ending balance. I mean, that's a pretty staggering success rate, 95%. Even with the 7.5% mortgage rate, which is a really high mortgage rate, and we chose that because of how high it is, it's still is quite impressive, ending up with 76%, having a positive investment balance at the end of the 360-month period. Now, of course, it is critical that we say it's this is past performance, and it's not indicative of future results. And your circumstances are going to vary greatly. This analysis is a tool that we're providing to help you with insights and to provoke thought rather than sort of a one-size-fits-all solution. And with that, it's really crucial that you consult with a financial expert and consider your unique financial situation before you make any significant decisions. This analysis is really only one piece of the puzzle. And, it's a complex financial world out there. So definitely take all of this into consideration. So I want to say thank you for joining us on this deep dive into the intersection of mortgages and the S&P 500. If you find this analysis thought-provoking or helpful, don't forget to like this video, subscribe to our channel, and hit the notification bell for financial insights. If you want to reach out to us on other platforms, they'll be posted below the video. Also, be sure to check out our website, where we post a daily blog Monday through Friday and have an Investment 101 series. Until next time, stay informed to make those financial decisions wisely.